having insurance that doesn't have replacement cost on property and or maybe has sublimits for like temporary living and like where you can stay while the work's getting done all adds up quickly. And again, if it's not covered by insurance, it's going to be covered out of your pocket.
If you're planning for or living in retirement, I'm willing to bet that you think a lot about your 401k, your IRA, maybe Medicare, maybe Social Security. But if you're a homeowner, I'm also willing to bet that you never think about your property and casualty insurance. The bill comes in, you pay it, and you move on to the next thing on your to-do list. But in this episode of Decoding Retirement, my goal is to get you to tap the brakes a little bit and pay closer attention to your homeowner's insurance. And joining me to decode all this is Meaghan Dowd. She's the author of Protect Your Lifestyle and Director of Insurance at Holistiplan. Meaghan, welcome.
Thank you so much for having me today, Bob.
It's a pleasure. I want to get started with a personal experience. You've shared that your passion for insurance stems from a personal experience as a young driver when your mistakes nearly caused your parents' policy to be non-renewed. Can you tell us that story and how that early experience shaped your understanding of how important insurance is, especially for folks who are on retirement's doorstep?
Yeah, of course. So, I think like many people, my parents assumed that's what insurance was for. So I backed into, a friend's car in the parking lot of my high school one time, did about, $3,000 worth of damage. So we called insurance to replace, fix that other person's car and our car. And then I had another one where I was pulling up to a light and I just bumped someone a little too hard. So again, another couple $1,000s. And what my parents didn't realize and what's really come to in the marketplace is frequency is a big thing. So while the claims themselves weren't big dollar amounts, and my parents could have potentially paid them out of pocket, what we learned was after that second accident, they were either going to have to potentially exclude me as a driver, so I wouldn't be able to drive if I was in another accident, and or they were going to be non-renewed from their current carrier. And while me as a 16-year-old, I'm like, but there's a bunch of commercials with carriers that say they'll take you for 15% or less. Why not just move to them? My parents quickly, told me that like, well, yes, we could. One, we're not going to get the same liability and or the same experience if we have a claim. And so I learned quickly that not all insurance is made the same, but also the idea of using insurance is changing quite rapidly. And what was once something that should be used is unfortunately getting penalized nowadays. And definitely experienced that at the young age with my parents of, when to use insurance, when not to use it, but also that not all markets are created equal.
Yeah. I mean, is it in your experience, this is a hard one. This is a big ask, right? Most people, I think, their eyes glaze over the moment you start talking about HO 12 and HO this and rider this and rider that. I mean, this is like not like fun stuff ultimately, right?
Correct. Yeah, people definitely glaze over, but that's where when you start to share your experience with an insurance professional and say, I have an art collection that I love, or I love to travel with my family, or I like to sit on a non-for-profit board, their ears are going to ring. So you don't have to get into the nitty-gritty of these are the losses I want covered, and this is what I like. Tell them about yourselves, where you shop, what you like to do, and they'll complement that with the right insurance product. If you're someone that buys off-brand cereal and is really nitty-gritty on your finances, and you're okay, you are just really looking to save and not have all the bells and whistles, they'll get that from the conversation. But if you say you shop at Saks Fifth Avenue and you have a custom kitchen, like that's going to have a whole different need, but just tell your story to them and they should really be able to pick up the cues based on the story you're telling them about yourself.
Yeah. I think it's either in your book or somewhere along the way. I think you've mentioned that inadequate insurance can, and this to me is really shocking, can delay retirement by 5 years. So can you walk us through a scenario where poor insurance choices have devastated someone's retirement plans and what mistakes they made?
Of course, yeah. And I mean, 5 years, it can be 10. It can really just change based on how dramatic it is. But we had a client one time that had a pipe burst. They went on vacation, like we all hopefully get the chance to do. And while they were on vacation, they didn't have anyone checking on their home. They didn't have animals. It was 5 days. We don't need anyone to do that. But when they came home, they found water in their home and not just a little bit of water. They had a pipe that had been bursting and running for 5 days consecutively, damaging kitchen, basement, HVAC, electrical. We all have these cool smart homes. What happens when all of that, is ruined? And so quickly they found out that while, yes, they had $1 million in dwelling coverage, they didn't have replacement costs on their personal property. So it wasn't able to replace all of those items in their home that were damaged, as well as they ended up having about 400,000 out of pocket. And so when you really think of that over a long span, That's what caused the delay, is them having to take that 400,000 out of somewhere to replace their home, rebuild it back to that same quality. And so that's where, again, having insurance that doesn't have replacement cost on property and or maybe has sublimits for like temporary living and like where you can stay while the work's getting done all adds up quickly. And again, if it's not covered by insurance, it's going to be covered out of your pocket.
Yeah, maybe drill down on that for a second, Megan. A lot of people might not understand the difference between what dwelling coverage and replacement costs and might think that replacement costs just comes with a higher premium, though it does protect you more so than maybe dwelling coverage.
Yeah, so in insurance, there's a few different limits. You have your dwelling coverage, which is going to cover the home and like the structure itself. And then consider taking the home and dumping it upside down. Everything that falls out is personal property. And when we say personal property is covered on replacement costs, that means even if the TV in your home is 10 years old, we're going to pay for you to go buy a TV at cost today. If you don't have replacement costs, it's going to be depreciated. So for simple math, if the TV 10 years ago cost you $1,000, it has a 10-year lifespan, and now you're at year 10, you're not going to get any money for that TV. If it has, maybe a 20-year lifespan and we're at year 10, you're only going to get $500 for that TV. So that's how, again, this actual cash value can really add up quickly because when you have a lot of items damaged that are a few years old, that depreciation, really adds up.
Right. And I guess the important thing there is to either document that you have all these personal items or videotape them or some way to catalog what you have.
Yeah, cataloging is, I think, a great idea. Everyone has cell phones these days. Just a quick videos, upload it to your Google Drive, some sort of drive. So if there is a loss, because proof of ownership is needed at time of a loss. So that's a quick and easy way to show adjusters the quality of materials in your home, the types of personal property you have without, again, 2 days after loss being like, okay, here's a white piece of paper. Now remember all the clothes you had in your closet and the utensils you have and the pots and pans. Yeah, it can become a lot without, a little bit of homework ahead of time.
Yeah. So you mentioned burst pipes. I have to share another personal story, which is the gas company is installing new pipes from our house to the main line, and the sewer pipe is right next to the construction of them putting in this new pipe. And so I called the insurance company to say if I should experience a sewer backup, I'd be on the hook because I don't have a rider. And they said, yeah, that's right. You don't have a rider. So I put in place a rider, but found that they would only cover a maximum amount for the damages from a sewer backup. But at least I have a rider now.
Yeah, and that limit changes. So I'd be interested to know what your max is. And I think that goes into another question of like, when do you know if you outgrow insurance? And the story might lend
Yeah.
itself to a great explanation of how you might learn quickly when you outgrow it.
Yeah, which is interesting. I think a lot of people don't think of themselves as wealthy, but their homes have increased a great deal in value, and all of a sudden now they need to have maybe a high net worth insurance provider versus a standard carrier.
Yeah, and so a lot of that comes with, I mean, your example is perfect. Maybe you actually had a finished basement and your insurance company saying, "Hey Bob, I can only give you 25,000 in water backup." And you're like, "But I have $100,000 of finishes in my basement. 25,000 isn't enough." That's a key indicator that, hey, you've probably outgrown your insurance company because water, sewer backup with a lot of companies you can get, especially high net worth, full limits, meaning whatever your dwelling's insured for. So if it's 500,000, then you get 500,000 in water backup. So sometimes your needs will indicate when you've outgrown. Another example is cyber coverage. That's not available with every market, but with the Internet of Things, some people are super tech savvy. And so when you have your phone connected to your car, connected to your home, and someone hacks into one of those, they can hack into your entire system. And we see a lot happen there. And so maybe cyber protection is something you want to purchase through insurance. That might be an indicator that, hey, my current company doesn't offer it, but I know it's available in the marketplace. I've probably outgrown them. We see
Right.
this with liability limits a lot too, where a client wants 5 million in liability, but their current carrier can only give them 2 million in coverage. And so again, a lot of times it does come at the direction of you as the client when your needs exceed it. But there are ways to be proactive about that, to your point, and it's maybe you're going to upgrade your home. And when you go to upgrade your home, think of the material you're putting in. A standard insurance company is going to replace with similar kind of quality. So again, not a huge difference, but a high net worth is same kind quality. So again, if you have super high end custom cabinetry, you're going to want same kind quality. You're not going to want them to be able to go get a similar custom cabinet that isn't truly custom to put in your kitchen. So that's also when your quality of finishes start to kind of get in that custom-ish range, is also where those standard carriers may not always be able to support a rebuild accurately.
Yeah. Megan, we have to take a short break, but when we come back, we'll pick up where we left off and talk more about a topic that I hope we're not, people's eyes aren't glazing over. This is really valuable stuff. So we'll be right back. Welcome back to Decoding Retirement. I'm speaking with Meaghan Dowd. She's the author of Protect Your Lifestyle and director of insurance at Holistiplan. Meaghan, when we left off, we were talking about high-risk carriers or high wealth carriers for wealthy, but I want to turn my attention to how retirees often have funds in their 401k or an IRA, and they might lose creditor protection. And this seems like a massive blind spot for folks. How should retirees structure their withdrawals and insurance to maintain protection of their nest egg? And if you have examples of how people have done that, that would be great.
Yeah. So I think, when it comes to when I initially talk to a client that's in the middle of their life making money, we kind of say your 401k is very well protected. We don't totally need to consider that from like a creditor accessible asset. But to your point, what a lot of folks forget, and a lot of my clients, we open their eyes here, was when they were approaching retirement and starting to get those distributions into their Bank of America, their commerce accounts. Once they go in there, they're not as protected. So that's when, or they're not protected at all, meaning if you have a bad auto accident, those and your auto insurance is not enough, creditors, a judge can say those funds are now accessible to make that other party whole again. Where I've seen clients do a really good job is working with attorneys and advisors to help with the structuring, because insurance is just going to protect it, but the structuring and where it goes is important. So whether that's into a trust, obviously different trusts have different protections, or I've seen where clients sometimes do LLCs, not as common as a trust. But the key to structuring is making sure you follow those structuring rules. And I have an example where I had a client who was going through retirement. Part of their retirement was they were going to become a property investor. So they were renting homes, they were putting the business in the name of an LLC. But then the wife one day called to make the insurance payment on that rental property with her personal credit card. And that would have pierced the corporate veil of that LLC completely, again, removing what they had designed as their protection and their structure. And so that's where, again, understanding the entities that you do end up choosing is important. For the trust, I've had a lot of people move their homes into trust. It's a great way to protect it, but they then don't add the trust to their homeowner's policy. And I had a client who had a loss and the home was in the trust, and our insurance policy was only protecting them as a named individual. Well, as named individuals, they didn't really have any assets because they had done the right thing and put them all into protected entities. And so now they had to hire an attorney to protect the trust because the liability from the homeowners was not extending. So that's where, again, even when we do structure, we still have to loop insurance back in, because insurance is a contract that, again, these types of things matter. And so I would say the biggest piece with trust specifically is make sure they're listed on your homeowner's policy. It's a big gap that I see a lot of clients making frequently.
Yeah. So speaking of gaps, retirees, they enter this new phase of life. They're not working. Maybe they start traveling. Maybe they downsize their home. Maybe they, go buy an Airbnb. So do you have an approach for evaluating what the lifestyle risk might be, what the coverage gaps might be? Like, for instance, do they need more umbrella insurance, or do they need what are the gaps, and what are the ones that are most overlooked?
Yeah. So, I have a lifestyle questionnaire. It's in my book. So I recommend starting there if you don't have an insurance professional that you work with and trust. But it really comes down to risk tolerance, because as a reminder, insurance is transferring risk that you're not comfortable carrying. But one of the biggest ones I see all the time is hired help. In states like California and New York, they do have workers' comp in homeowners policies, but a majority of states exclude workers' comp from your home policy, meaning when that handyman comes on property, when that full-time nannies at your house taking care of your kids 40 hours a week, when that home healthcare professional is taking care of your parents, all of those people bring liabilities onto your property that are often overlooked, from employment practices liability for things like discrimination to, again, that workers' comp if they get injured. So, uh, um, people on property working for you, you don't have to be wealthy for that to occur. So I do think that's one of the most like overlooked ones. But then obviously like traveling, something we love to do once we retire. And liability with a lot of insurance is only provided in the United States and its territories. So if you are one that wants to go to Europe and rent cars or rent, a nice house for a few months, making sure your homeowners is worldwide liability is something else. And again, that's what my lifestyle assessment would help you figure out within my book. And it also will help you with your risk tolerance. I think a lot of people feel like they have to write a deductible check every year. They forget that they just write that premium check every year. And so going with the right deductible, especially in retirement, is important because you don't want to have to overpay for insurance, but you do want to make sure if there is a loss, you can comfortably write that check, whether it's 2,500 or 25,000. I think that risk tolerance also is a big piece that's often overlooked as we approach retirement.
Yeah. So one story that's been in the news quite a bit over these past few months, years even, is how some communities become uninsurable. Places in California because of fires, or places in Florida because of hurricanes, et cetera. What advice do you have around insuring what might seem to be uninsurable?
Yeah, so this is really heartbreaking in my opinion. What I see happen here, I had a client that reached out to me in Florida when I was on the broker side, and he was trying to sell his home. And it was built in 1995, and he could not sell his home because it had not been upgraded. So nobody wanted to buy it because it didn't have the shutters it needed to have, and it didn't have all these wind mitigations. And he had this house paid off, and that was his retirement nest egg that now had really no value in it because of the insurance market and the requirements it would take to bring his house up to code to qualify for insurance. So what we see a lot of times too is, in Missouri, we had a tornado go through a few years ago that knocked out an entire community. And we saw portions of that community not able to rebuild because the entire neighborhoods did not have the right insurance. And so they all just moved on elsewhere. They bought houses, they rented elsewhere, and that community never came back to the vibrant place it once was. And again, those families that had paid off their homes as this is going to be our retirement nest egg found themselves in really difficult situations because of that. And then the last piece, I had a client that was going to buy a home and they had cash that they were going to pay for the home, but it was in a flood zone. And so what I had to remind this client of is just because you have cash and it being in a flood zone doesn't affect you today. When you go to resell this, most people don't have $500,000 cash to pay on a house. And so that flood insurance is going to affect them. So your value today of 500,000 might go down to 300,000 once the requirement from a mortgage is flood insurance. And we see floodplains changing all the time with FEMA. So again, that's another piece is you might not know insurance complications because you have a home paid off that when you go to sell it, you might have to unfortunately learn those market conditions at an undesirable time.
Yeah. I live probably maybe a fifth of a mile away from the ocean, but we're 100 feet above sea level. But our insurance company wouldn't bundle our insurance with our car insurance because they said we'd live too close to the ocean. And I said, well, yes, but we're 100 feet above sea level. It's going to take another 1,000 years before the water reaches us. So it didn't matter though. We still had to go find another insurer.
Yeah, and that's a great point of again, sometimes, when you outgrow markets, there might not always be a market to go to. So that's something that again 10 years ago wasn't an issue, but as you're finding that the market is limited sometimes and like who's willing to take on a home that has certain features even if it's just proximity to water.
Yeah. We have about maybe 2, 3 minutes left, Megan. So let me jump ahead to something. Can you give us like sort of a 3 or 5 steps that people need to do when they're doing a review of their insurance to make sure that they have the appropriate coverage?
Yeah. So I think the first thing is one, to look at the replacement cost of your home. If you have not looked at the replacement cost since you purchased your home, whether that was 2 years ago or 20 years ago, work with an insurance professional and or a financial advisor to calculate that number because most likely it has not gone up appropriately, and or you've made adjustments in your house. When you bought it 20 years ago, it was laminate stuff and now it's granite. And so I think replacement costs on your home is one big thing to look at each year. The other piece I would talk or think about each year is lifestyle. So again, what are you doing differently today than you did last year? Maybe it's nothing and that's okay. But even if it's, oh, my wife started walking dogs on the side because all the kids are in school and she needed something to do. Those things matter to an insurance policy. And so the littlest changes, it's okay to disclose and have those conversations. I think the other piece on an annual review, again, you don't have to be a nerd about the market, but understand what's going on in your community. Understand if you're in Florida and in California, what adjustments are happening. It just helps it sit a little better. So maybe you're getting a 40% rate increase in California, but the market itself, half of your neighbors aren't even getting renewals. They're getting non-renewed. So it might just help that 40% increase not seem as uncomfortable knowing there's other people in the market that don't even have homeowners options this year. So that's where I think reviewing and just understanding that market readiness. And then any major changes to your home. So if you've updated the plumbing at all, if you've done any, upgrades to the electric, the roof, those are all discounts that can be added to your policy. So anytime you, again, do what's considered maintenance, talk with your insurance professionals and let them know because you could have some nice discounts added. And then the last piece I would say is think about ways to mitigate risk every year. So whether that's installing a water shutoff valve, or again, if you're going to hire someone to come clean your home and make sure they have their own insurance and they're not relying on you for workers' comp. So just again, each year, think of things you're doing. And if it's something that you could tweak a little bit to just relieve your liability and not have to pay for insurance to cover that risk.
Yeah. Meaghan, we've run out of time. I want to thank you for sharing your knowledge and wisdom. Our goal here at Decoding Retirement is to become someone's first and last stop in their search for knowledge about retirement. And this is a really important component of someone's retirement plan. So I really appreciate you sharing everything with us.
Yes. Thank you for having me. Hopefully everyone stayed engaged and I'm happy to answer any questions that follow.
Great. So that wraps up this episode of Decoding Retirement. We hope we provided you with some actionable advice to help you better plan for or live in retirement. If you have questions about money or retirement, you can email me at yfpodcast@yahoo.com. And lastly, remember, you can listen and subscribe to Decoding Retirement wherever you find your favorite podcasts.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.